Hey, listen, everyone. Thanks so much for giving me your time. And what I'm going to talk about today is how to make money with stocks and options, even if you're new to trading. And I'm going to skip through a lot of slides because I only have 40 minutes to give the presentation, and the whole thing could take well over an hour. So I'm going to move through some of these slides pretty quickly. The one thing I want you to know is you're not going to listen to 40 minutes of background information, 10 minutes of trading information, and then a 15-minute sales pitch. What I want to do is I want to make this very highly educational. I want to teach you the principles that we use to trade. They're all based on mathematical modeling, and that's really what I want to focus on. Now, I'm going to skip this. And I'm going to move through these slides. Now, I want to show you that this is one of the tools that you're going to get with the software. And this is our market scanner. Now, the market scanner allows you to scan on any time frame or multiple time frames. You look at a 2-minute, a 5-minute, a 10-minute, a 4-hour, an unlimited number of stocks, flashes a buy, and that's when all of our indicators are in alignment and you're prepared to take a trade. So it really bypasses a lot of the wait and see and moving from chart to chart. And, we also don't trade the traditional looking for a breakout, looking for a momentum trade. We're looking for an alignment of the forces that we use to predict how price is going to move off the right edge of the chart. Now, a little bit about myself. I'm a graduate from an Ivy League university. I went to the University of Pennsylvania. I was inducted into the Phi Beta Kappa Honor Society, which means I graduated in the top 2% of my class. I was a full-time professor at Jefferson College in Philadelphia. And during that time, I published over 15 peer-reviewed articles. I consider myself, first and foremost, to be a scientist and an educator and an academician. I have made a lot of money trading. I've helped more than 30,000 traders become profitable, and I'm an international speaker. And in fact, in about 3 weeks, I'm going to the Philippines to speak, as long as the coronavirus hasn't invaded the Philippines. Now, just a little bit of background about myself and about our software. It's based on mathematical modeling. And in my graduate and undergraduate work, I worked with the U.S. Navy. And the University of Pennsylvania had probably the #1 department in the world of decompression or underwater physiology. It had 4 decompression chambers where divers would go if they got the bends. And back in the day when I was training, which was quite some time ago, I don't want to tell you how old I am, underwater decompression schedules were very dangerous. The Navy would have divers go very deep, and on the way up, they had to switch oxygen mixtures, and they had to take periodic rests. This was all done just by guesswork. There was no mathematical way to model how to create these underwater decompression schedules. So the Navy came to my mentor and to me and asked us to optimize these things. And what we did is we put all the physiological parameters that are relevant to underwater decompression sickness into a multivariable equation, and we optimized it using a program called ASOP, Underwater Engineering and Scientific, Automated Engineering and Scientific Optimization Program. Now, that's exactly the way we treat the markets. Now, I want to skip, this is about my background, and actually, I started as a plastic surgeon, but I want to move past that. Now, the Trend 3 system, and I will talk to you about that, but I just don't have time. I mean, if you want to see a picture of me and my son. That was when I was practicing plastic surgery. And I'm a single dad, and that's one of the reasons why I closed my plastic surgery practice, and I moved over to full-time trading. I was going to say him. I was a single dad, 24/7, 365, and I was operating 6 days a week, like 10 hours a day, and no time for him. And I subsequently developed a really great relationship with him, and this is in Breckenridge, Colorado, about 3 weeks ago, and that's him doing a ski jump, and I can't do those, but that's me and him now. And you can see he's grown up quite a bit, because it's been 15 years since I closed my surgery practice and moved over to trading. So what I did was I looked at all of the software out there when I moved to trading, and I saw that it's all based upon certain premises. Software is repackaged, it's renamed, but it really has the same underlying philosophy behind it that sent 95% of day traders off the cliff. It has not even, the science of day trading has been a failure. I mean, if you look at medicine, for instance, what we do is we look at what works and we determine what works via rigorous mathematical testing. I mean, in terms of a medication, we'll look at 10,000 patients and determine whether or not a specific medication is effective over placebo. And if it's not, we dump it. We don't use it. But we don't do that with our indicator analysis. And so what we've done simply is we repackage them and we rename them, but there's been no evolutionary movement forward in day trading and swing trading. We still trade the same stuff that we traded 35 and 40 years ago. And that's why that 95 to 98% failure rate has not improved. Now, that would be absolutely unacceptable in any other scientific field. And I have no idea why it seems to be acceptable for traders. And I really can't answer that question, except that when I closed my surgery practice and I moved over to trading, I could see that nothing out there was going to make me any money. And again, it was all based on the same premise. Now, there is a big difference in the markets today, and it's a difference that you have to take into account, or you're going to lose your money, all of your money. If you go back to the days of Japanese candlestick patterns, Elliott wave, Gann theory, even Fibonacci, although I know they're Fibonacci supporters, and there always will be. I've done a mathematical analysis on Fibonacci, and it does not work. Rising and falling triangles, these are things that have been around for 40 years, and yet almost everybody still goes bankrupt. So why do we embrace these things? I don't have any idea. Now, here's the problem with trading nowadays versus the way it was maybe 15 or 20 years ago. 15 or 20 years ago, Japanese candlestick patterns, price action, all of this stuff, divergence signals, MACD divergence, oscillator divergence, it was pretty relevant information because in essence, the power of each individual buyer was equal to the power of each individual seller. Like the market consisted of an enormous number of small traders like us, and we determined the trend. But that is not the case anymore. Now, 70% of all volume on stocks, futures, and Forex are determined by the big institutional guys, by the big banks, by the algorithmic triggered trades, when a computer flips a switch. We've all seen it. If we trade a stock, it's going to reverse in direction and it can go up 15 or 20% simply based on the interjection of institutional money. And institutional money doesn't care about Fibonacci. It doesn't care about price action trading. It doesn't care about Japanese candlestick patterns. When it triggers, you're going to get run over if you're using any of these other methods to try to trade. The only way, in my humble opinion, that you can make money is to wait until the institutional traders step in and get in either right with them or just 1/2 step behind them, actually in front of them. Because all our indicators lead price, which I'm going to show you. That's the only way to trade. And if you try to trade any other way and you use divergent signals and all the things I mentioned, institutional money is going to crush you. And one other thing, any software that tells you you can call a top or a bottom is absolutely broken, or its developer is a little bit off the trail, because a top and a bottom are called by institutional money, not by any mathematical derivation. And you and I both know that a stock can be overbought for days, for weeks, or for months. As long as the institutional money is pouring into that stock, it's going to continue to rise. And I don't care if the oscillator gives you 22 divergent signals or it stays overbought, the stock is going to continue to rise. So you can never call a top and never call a bottom. Or all you can do is try to get in 1 step ahead of big institutional money. And here's how we do it. Now, I wanted to show you a trade evolve in real time. This is actually a video. This is a live trade, and I want to move it to right where the trade starts. This is the software. Now, one of the things that we base our trades on are running over traders caught in the counter trend direction. And in this pivot, there's a bunch of sellers because they turn the market here. So on the break of the pivot, these sellers are going to start to get stopped out. And as they start to get stopped out, they're going to propel the market to the upside. Now, I haven't even gone over what these 3 lines are, but these are the 3 key forces that move price on any time frame and on any financial instrument. Background bias is simply the multi-time frame alignment of the instrument you're trading. I'm going to go over that in more detail. But you're going to see the system take a trade. We always project our targets and stops. We have a very, very transparent trading room. And, winners don't appear out of the woodwork, and losers don't vanish. So if you give the trade another second or two, it's going to hit. That's me squeezing the chart when we make the video. We took this trade, and there's the fill. It's on the break of the pivot. You need a 2/3 candle body close above. Now, all these sellers are going to start to feel a significant amount of pain if this candle just pushes a tick or two to the upside. Now, we have the 3 forces that move price aligned. And target filled. And you can see it flying. And the reason it's flying is because essentially you have a short squeeze. And the short squeeze is created by the pivot. Target. And you're out. Now, the amount of money you made is related to the amount of shares you traded, or the amount of contracts you traded, or the amount of lots you traded. But we're always trading in the direction of these 3 forces and in the multi-time frame alignment of the instrument we're trading. Now, the key is we're going to select a stock that's ready to move, and we're going to buy the best option strategy. We're going to enter the trade, and it's easy to manage these trades for profit. And I want to move pretty quickly. Now, the three key forces that move price are the multi-time frame alignment, multi-time frame assessment of momentum, the multi-time frame assessment of stochastic, and the multi-time frame assessment of order flow. Now, the other huge mistake that I see on almost a 99% of software, that it utilizes information provided to it by your trading chart. You cannot care about any information that comes off your trading chart. If you include that in the indicator analysis, it's going to confound the assessment and simply not going to be accurate. You'll only want to look at the indicator assessment based on the two higher time frames, because that's what's going to create the leading indicator analysis. And if you go back and look at your trading chart, you're done, because it's just not going to work. So the first that we look at, now I like to display price via Unorenco. And we have specialized Unorenco, they're called modified Unorenco. They come with the system, but you can trade time, tick, range, Renko, anything you like. Remember, if the forces that move price are not time frame independent, candle, stick, type independent, then they're broken. So I just happen to like this because I don't care about price action. I don't care about Japanese candlestick patterns. I'm only interested in the trend, and I think it's displayed very well by our modified Unorenco. So what we do, and I'm going to simplify the assessment a bit just for the sake of time. What we do is, here's your trading chart. And we don't care about momentum on your trading chart. We only look at the two higher time frames. Now, what are these two higher time frames? Well, if you're trading a 3-minute, they're the 9-minute and the 27-minute. They're 3 times 3 is 9, and 3 times 9 is 27. And the analysis based on the MACD, which is what we use, and you can use Heikin-Ashi, you can use Stochastic, they all give you nice momentum assessments, only I happen to like the assessment of momentum based on the MACD because it gives you that MACD crossover. Now, if you look at the MACD on your trading chart and you add it, it's going to destroy this assessment, because the MACD in your trading chart, irrespective of the inputs, and everyone's always looking for that magic input on MACD, it doesn't exist. MACD will never lead price on your trading chart. But the two higher time frames, when they align in terms of momentum, will tell you the direction that price is going to move on your trading chart. So this is the MACD line. I removed everything else because I just wanted to give you a feel in this fairly short lecture exactly what we're looking at. And in both cases, the MACD line is accelerating away from the signal line on the two higher time frames. And remember, momentum is a second order derivation. It doesn't measure the speed of price. It measures the acceleration of price. So what this is telling you on a long trade is that the close of the candle is approaching the high of the candle. And as the close slowly worms its way towards the high, price is accelerating towards the upside, and you get these two momentum assessments. When they align, price on your trading chart is almost always going to move up. And here is an example. Now, you can see that price falls, but this momentum line turns green first. So the first up pivot is going to be your trade. And if you try to counter trend trade against this multi-time frame assessment of momentum, you're going to get beaten up. And that's probably, if a lot of you are getting stopped out and can't get a runner or a winner, this could be one of the reasons. Now, you see these traders caught in the counter trend direction. I mean, what the heck are they doing? They're trading divergence. MACD or oscillator. They're trading off of fib resistance. They're trading price action. Whatever they're doing, they are never going to be profitable. But what do they do for us? They help us, because as price continues up, they're going to stop these traders out. These have all shorted the stock. As price continues to rise, they got to buy it back, and they're going to propel the market further to the upside. And you can see the turn is called by the 3 line. The candle halo actually means a lot. I'll talk about that in a minute. But you see the 3 line here is a line to the downside on an up candle, and price turns. So we're always going to trade in the multi-time frame direction of momentum. And if we don't, we're going to have a lot of trouble. Now, we do the same thing with stochastic. Now, the triple screen method of trading was not invented by me. It was invented by the guy by the name of Alexander Elder in 1997. He put out a book called Trading for a Living. I used to correspond with him all the time. I've lost touch with him recently, but he made money. He made millions of dollars trading in the markets during the 60s and 70s, when trading was very primitive in terms of indicator analysis, simply by only looking at the 2 higher time frames, ignoring price or any analysis off the trading chart. And he called that the triple screen method of trading. Now, as far as the stochastic assessment is concerned, I just left in the percent K line. And when the percent K line is moving to the downside, now again, if you're trading a 3-minute, it's a 9-minute and a 27-minute. Let's say you're trading a 5 range. It's the 2 higher fib numbers. Although fibs in no way are going to call support and resistance for price. Remember, price is based on market sentiment, or it's based on, nowadays, it's based on the big money. And they are not going to respect fibs. Fibonacci was a 14th century mathematician who created Fibonacci transformations, and from those Fibonacci numbers. And they're very elegant, but they don't describe the movement of any closed system. Well, they describe the number of edges on a snowflake and the number of ridges on a pine cone, but they don't describe how any closed system moves. And I have really nice videos of how a molecule moves. And a molecule, electrons revolve around the nucleus based upon defined forces that keep them in an orbit. Well, it's the same thing here. Price moves based on specific forces, and we're defining them. And things like Fibonacci play no role. So we're looking for the percent K line to be moving to the downside on both higher time frames. If you're trading a tick chart, you're trading a 377, the next higher fib number is a 610. It's looking at that here. I forgot the next higher fib number, but whatever it is, that's here. And it defaults to that. So you don't have to set it. Whatever you set your chart speed at, the indicator will automatically look at the 2 higher time frames without you doing any work or having to try to figure out what they are. It's going to do it automatically. So now what we have 2 forces that we need to align. What we're doing is we're trading what's called with more specificity. Now, I want to talk for 1 minute about specificity. What is our goal as a day trader or swing trader? Now, when I talk to, I have 175 day traders in my room. We make money almost every day. And almost all of them, when they come into the room, they say, our goal is to get winners. And that's 100% wrong. Your goal as a trader is to avoid losers. It's not to get winners. Anybody can get winners. I mean, if you're the worst trader in the world and you're going to take a $100,000 account down to 0 in a week, you're going to get lots of winners. What you're not going to do is be able to avoid the losers. And avoiding losers is called trading with specificity. Now, when you trade with specificity and your goal is to avoid almost every loser, some winners are going to get by you because they simply don't align for these forces. But you can't care about that. All you have to care about is avoiding the losers and getting into the trades that align with your system. And if you do that, you're going to make a lot of money. Now, when you have stochastic and momentum, both aligned in the same direction on a multi-time frame basis, ignoring your trading chart, price on your trading chart is almost always going to follow their assessment. If you try to counter trend trade them, you're going to get stopped out. And again, it's time frame independent. It doesn't matter whether you're trading a 1 minute, a 4 hour, a daily. These are fundamental forces that move price. Now, the last one is order flow, and it's the most elegant and the most difficult to assess. Now, most software creates an order flow assessment that's absolutely wrong. And I'm going to show you in what way it is wrong. Now, I took this off of somebody else's indicator. I just blotted their name out because my goal here is not to say anything negative about anybody. But what they do is they look at the absolute value of the market delta and off of that predict how price is going to move off the right edge of your chart. Let me show you the problem with this. First of all, every one of these price values, and since we're focusing on stocks, this is a cent. It has traders sitting at the bid and traders sitting at the ask. In other words, some are looking to buy and some are looking to sell. Now, whether there are more traders looking to buy or sell is calculated by the market delta. The market delta says there's 2,985 more buyers just sitting on the dome than there are sellers. Now, we know that sometimes these are just phantom trades. Institutions will put them on and take them off. But basically, they do it on both sides of the dome. So they pretty much even out. So the market delta gives you a pretty accurate assessment of whether there's buying pressure in the candle or selling pressure in the candle. Here's the problem with it if you use it off your trading chart. Only one standard deviation's worth of data works. And if you look at this candle here, this is a hugely negative market delta, and the candle closes to the upside. Now, how could that be possible if there's such an overabundance of sellers sitting on the dome? You would consider that all there is a huge amount of selling pressure. Well, the answer really is simple. And the reason is that the buyers are more aggressive than the sellers. Let's say this is a stock trading at 50 bucks. The buyers are only going to, the sellers are only going to sell it at $49.99. That's it. But although there are fewer buyers, they're willing to buy it at $50.01, $50.02, $50.03. And so because they're so overly aggressive, even though there's an abundance of sellers, they put so much buying pressure on the candle, it closes to the upside. So in order to make this assessment work, one, just like everything else, we cannot use any data from our trading chart. And two, we have to filter out the outliers. We only want to look at one standard deviation's worth of data and get rid of the outliers. If we can do that, then the market delta will give us a very accurate assessment of who's in control of the market, buyers or sellers. So what we do is like we do with everything else, we look at the two higher multiple time frames. Now I have this for Unarenco, but we know if you're trading range, it's the two higher fibs. If you're trading time, it's 3 times your trading chart and 3 times the next higher time frame. It's easy to determine what those 2 higher time frames are. The algorithm of the indicator will do it. Then we look at the market delta of those 2 higher time frames, and we put them in a 15-period simple moving average. So what determines whether the bulls or the bears are in control is not simply one market delta derivation. It's the average of the last 15 derivations. And those last 15 filter out the outliers. So when there's an occasional up candle with a negative delta and a down candle with a positive delta, it will not change this slope. So when the 15-period SMAs are sloping up on both higher time frames, the bulls are firmly in control of the market. And when both 15-period SMAs are sloping down, the bears are firmly in control of the market. And when that 15-period SMA are yellow, it means these 2 lines are not in agreement. It defines chop, which is extremely important to define, and we don't trade. So here's an example. Now we've got 3 lines to assess. And you can see here, there's no triple greens and there's no triple reds. And that defines chop. And we're going to stand down here and we're not going to trade. Now we have triple greens, order flow, stochastic, and momentum on a multi-time frame basis are aligned to the upside, and price is almost always going to rise. And I highlighted this automatically just to sort of try to be fancy, but don't just ignore it. I shouldn't have done it, but if you want to see lines trace out of the blue, you can. So you see this counter trend trader? Forget it. I mean, if that was you before, it's never going to be you again. Look at these traders here. This trade is a huge short trade. Why are they trading to the long side here? Well, again, it's the old Japanese candlestick patterns, price action trading, oscillator divergence, MACD divergence, fib support, Elliott wave, Gann theory. I could go on and on and on. Or they're trading off of information that's provided them by their trading chart, which does not give you, it's always a lagging analysis. This is a multi-time frame analysis off of the higher time frames only. It doesn't care what your trading chart is doing. So unlike almost all the other software you see, these lines are not red because price is falling. Price is falling because they're red. And these red lines are created by the higher time frames, not price on your trading chart. And you don't want to be caught in the counter trend direction. Here's another slide. Long only and short only. And all we're going to do is run these long traders over and stop them out and help propel this trade to the downside. When you don't have triple reds or triple greens, you stand aside. Now, we do get a system-generated entry. It's based on an exponential oscillator, which does use information only from the trading chart, but the entry has to be confirmed by the software, by the multi-time frame analysis. I got to move faster. I'm going to run out of time. When the percent K line crosses the 50 line, you get a long signal to the upside. To the downside, you get a short signal. When the percent K line to the upside, you get a long. You get a short. You get a long. And here's what you see. There's your oscillator signal. On triple greens, up you go. Here's your oscillator signal on triple reds, and down you go. Now, you can stay in these trades for a long time. Now, you'll notice that one of these candles is black. That's because the assessment is a little more elegant than I'm making it out to be. This is your exit when the 3 line turns against you. So you're in this trade all the way. Oscillator entry, long above the 50, 50 is green, 15 is green. These are both exponentials, and actually they're proprietary. This is an exponential of an exponential. It moves smoother than an exponential, but really quickly. Here's your exit. Down, neutral candles, you don't care. 3-line turns, you're out. And remember, the 3-line is going to turn on a down candle. So you don't have to take the pullback and be out on that candle. You're going to exit at almost at the bottom of the trade. Now, background is extremely important. That determines the multi-time frame trend of the stock you're trading. So let's say you have order flow, stochastic, and momentum aligned to the downside on a multi-time frame basis. We want even more. We want the stock we're trading aligned to the downside on a multi-time frame basis. And remember, it ignores your trading chart. And it does a very, very complex assessment of the 50, the 15, and where prices. This dark pink is the sweet spot to trade. And this is a $1.35 move short. And these are smaller trades, 45, 65 cents, 65 cents, a $1.30, but always in the direction of the multi-time frame alignment of this stock. I purposely took off the time frames because they're irrelevant, and the stock is irrelevant. The only thing that's relevant is that we're trading in the multi-time frame direction of the stock alignment, and we haven't even put it all together yet. Here's a move to the upside. Now there are 3 up colors and 3 down colors. Strongest up is dark green, strongest down is dark pink. If you come aboard, I'm going to give you a master class and teach you the difference between the other 2 up colors. They're weaker. This is the sweet color to trade. Here's 205. Here's a $1.60. And we don't care if there's a retracement to mean. As long as everything stays in alignment, we're going to continue to stay in the trade. Now, I don't have the 3-line here, but we're going to put it all together. I'm going to go through these really quickly now. Now, pivots are really important, and I also want to go through these super quickly. We not only have pivots, but we have areas of where there's a buy-sell imbalance. It's a multi-time frame assessment, and right here it tells us there's an overabundance of buyers. It's based on the volume ladder looked at on a multi-time frame basis, higher time frames only. So we know if we trade into this, we have a great chance of price bouncing right back in our faces and stopping out. And because it's a multi-time frame assessment, you see price went through it, but it never broke it. And it turned price, and price shot up. So we stay away from pivots and these multi-time frame buy, sell, and balance zones. And it keeps everything, it keeps our risk low. And you can see price comes down and bounces, down and bounces, down and bounces. It comes down and bounces. Down, bounce, bounce, bounce. We stay away from these areas. Up, down, bounce, bounce. There's too many sellers here to try to challenge them on a move. So putting it all together, we're not going to do complex option strategies. We're going to do simple. Later on, we're going to do complex. When we start off, we're simply going to buy an at the money or in the money call on an entry that's called by the 3-line and the oscillator, and up we go. And at the money, 80% at the money. At the money, 105% on a $1.35. You can see the candle is haloed in blue. That tells you that the 3-line is aligned to the upside. We've got green background. It's the only time we're going to trade. This is 125%. We're never out until we get this down candle. At the money, I trade in the money because I'm so sure that this is going to go in my direction. Now, I'm going to have to run through this. Again, this is the market scanner. It's going to give you these trades. You can watch 100 stocks if you want. This also works on Forex and futures, but we're focusing in on stocks. It puts you into the stock at the right place, and the stock will rarely move in the opposite direction. Here's an entry on Apple. I was going to look at the one on McDonald's. Your entry signal is right here. You get it here. It goes $3.30. This is a 30 Unorenko. This took about 4 hours to evolve. Now, I quickly want to go to the offer. So when you're in a trade, as long as you don't get a magenta halo, you stay. If you're in a trade short, as long as you don't get a blue halo, you stay. And you can halo these candles in whatever color you like and make it whatever thickness you like. It's totally up to you. So let me go right to the offer. We get the Trend 3 software. It really is easy to learn. It's very intuitive. And you're going to get a master class. I'm going to teach you exactly how to trade it. And remember, this is not a lease. This is a buy. You're not going to pay us any more money. You do upgrades and add-ons, you get them for nothing. So I'm going to skip a lot of this. You're going to get the market scanner. So you can look at as many stocks as you like. And as soon as you see the sell, pull it up, and you're very likely going to get a great entry. Now you're going to get my options alert newsletter, which has been broken into two pieces. One are my options, and the other is my small cap and micro cap biotechs. Now, you know I have a background in medicine. And I mean, I was a surgeon for 15 years, and at the University of Miami, I worked with 5 professors of medicine, one in neurology, one in hematology, oncology, one in immunology, one in cardiology, and one in neurology. We look at all the small cap and mid cap biotechs that are coming up for FDA approval of a novel medicine.
Hey, Mark, I'm sorry to cut you off there, but our next presenter is on board.
Or can I just finish this really quickly? Just my offer.
Okay, sure. I'll blast out your offer to the audience as well.
Okay, and here's all the biotechs. I've taken 12 trades, 12 winners. Options portfolio over 100%, 2 years. I mean, I got to go really quick. These are some of my options trades. You're going to get a 6-hour digital class on how to trade options the way I trade them. I'm just going to skip that. This is going to, all this stuff's going to help you trade. You get free lifetime updates and upgrades. Now, the total value is $5,600. You get VIP support here at the office. We're gonna back you up. We do all the installation. You do nothing. And we have a master class. Every month we all get together. There's a few hundred traders in the room. We have open chat. We exchange ideas. They're wonderful times. You're going to come into my training room for a month, and it comes out really to a lot of money. But what we're going to do is we're going to sell it to you today. It's for $997. And remember, it is a lifetime purchase. You are not going to pay us another dime for an upgrade or an add-on, and we always are improving the system. You have to put the code TREND3 in capital letters with a 3, and that $8,000 price will drop to $997. And I'm just going to stop here and thank you guys for having me, and I appreciate all of you for listening to me. I really appreciate it.